going to want to see this. So I'm here today with James Floyd, who is a director, I believe, right, at Beacon. And Beacon is an SEC regulated company, which is in the UK, US, and other places. I mean, James will tell you more about that particular. I've got an echo. How about James get started whilst I deal with the echo?
Of course, absolute pleasure to. Well, thank you very much, Adam, for inviting me on to speak about this. As Adam mentioned, I'm the commercial director at Beacon Global Group. We are a 30-year-old federally licensed SEC firm headquartered out of Atlanta. I was actually the first hire outside of the US, which was a good 6 years ago. And we create solutions and connectivity for US connected persons and assets globally for wherever they are located or their assets are located. So that is what we do. For 20 years, we were just US broker dealers. So full service broker dealers, operational in 42 states. The implementation of FATCA, the increasing nature of FBAR filing, and what has sort of resulted in this has meant that we diversified into international spaces to where US connected persons, and actually vice versa, where European persons are in US domestic circumstances of what happens with the taxation element, what happens with assets that are both US onshore and then US connected offshore. And what we do as a company is that we are advisors for onshore US and for offshore US, for US expats, or for those who have left assets there. We are product providers and solution providers, and we partner with high caliber advisors such as Adam in assisting them to make sure that they have solutions available for their clients, to make sure that assets, investment strategies, tax sort of coherence is as its most efficient way taken as a sort of holistic global view. So that's a very quick overview of who we are as Beacon. I should say, as we are an SEC regulated firm, that nothing on this call can be constituted as advice. Anything that we do, invest value obviously can go up and down, full capital is exposed. We are regulated, as Adam mentioned, by the FCA, the SEC, the Guernsey Securities Financial Centre, also now in Switzerland and DIFC. And so all advice is held to that element. So I have to be respectful of what I say to those in those activities as well. So Adam, that's the overview. That's
a really good overview, really, yeah. And it kind of leads me on to something I was thinking about earlier, because obviously the regulation, it always seems to get more onerous, right? It doesn't ever seem to get less onerous. Although I was reading today that the Europeans are kind of considering MiFID and making it slightly less onerous, but we'll see what comes of that, and that's a different issue. But when it comes to the US side, all this regulation you talked about, and all the changes like FBAR and so on, but practically speaking, for like a lot of our clients or just Americans in general, both expats and those living in America, what do you think the main ramifications of this, regulation and legislation is? Do you think it's mainly just making sure you do all the reporting correctly, or it adds cost to the investor? Let's say practically I'm an American living in, I don't know, Germany or the UK, whatever. I mean, do you think that's the main things to focus on, just making sure everything is done correctly? Because if you don't do it, there's penalties now, right?
So I would say that the main effect of all of this is confusion. You're working with multi-jurisdictional tax codes. And as those of us know in the industry, it's hard enough being an accountant in this space. For just anyone else, it's a very difficult sphere to be navigating. And that sort of confusion leads to procrastination, and therefore you do not have your assets working to their fullest extent, that you will not necessarily be taking advantage of tax opportunities in the US through opportunity zone investing. You won't be exposing your assets in a PFIC, FATCA and FBAR compliant manner overseas. If you are perhaps a European individual who is going to the US, you might sort of commingle your assets as a family too quickly or not quickly enough. The sort of confusion with it just means that inefficiency is caused. And ultimately, as we all know, time in the market is much more important than time in the market. Adam, I'm sure you and I will get onto that as well, that my history is as a fund manager, and very happy to sort of talk about that. But it's exposure to market, to equity cycles, to different areas, that's really where the difference makes the difference in sort of portfolio size at the back end, where it comes from.
Yeah, and that's interesting because I mean, a lot of people have heard about these things like FATCA, FBAR, whatever. And as you say, there are a lot of people, it kind of causes confusion and worry. But let's say the most simple explanation of these kind of rules is that basically for Americans now, if money's held overseas, basically the American government, it's much easier for them to actually get access to that information, right? And essentially, obviously there's a lot more to it than that, but essentially that's the thing, right? So if you're an American, you hold a bank account overseas, even you hold a brokerage account overseas, that doesn't automatically mean you're doing anything illegal, but the authorities will know about it, number one, and number two, it can be tax disadvantageous depending on how it's structured, right? Essentially.
Of course. Well, FBAR falls into that. So FBAR limits now were they came into force under Nixon, and that was at $10,000, and they haven't adjusted with inflation ever since. So as a US person or a US connected person or someone born of an American or commingled assets, or you hold a equity interest in a US operating company, so such as an equity partner in a US law firm, any account that you hold which hits over a high watermark of $10,000 in a year, you have to file all of that on your FBAR filing. FBAR filing is obviously not that onerous, but that sort of sets off the chain for then PFIC taxation, which is at 37%, and then sort of you're looking at inheritance tax and everything over the top of it. Bless you. And that's
I should have muted a bit.
So there's nothing. Realistically, there's nothing to be fearful of any of this that it's laid out. It can be onerous, and dual tax agreements are in place everywhere, so it shouldn't have an effect. But dual tax filing means that there's 2 tax returns a year that you are having to put in. So it does create an extra work with it. So it's the importance of working with good accountants with this, and the sort of ergo, it's important to make sure that your assets are structured correctly and working as efficiently. And to my earlier point, which I probably make a few times, is that and you're taking advantage of everything that you are entitled to. As we all know, in sort of all accounting and all aspects of sort of tax return, the phrase, well, that doesn't seem fair, comes out all too frequently. So where you do have an opportunity to take advantage of something that is there as a US sanctioned IRS process, then it works really well with it.
Yeah, and that's interesting because one thing I was thinking about as well, and this was a question we got before the webinar, but we are going to have a Q&A session a bit later, interactive. But one question I got asked before the webinar was, in the current situation, right, a lot of people's residency is completely up in the air. I mean, this is an example of it, right? I'm in self isolation, albeit in an Airbnb, making this webinar. But for some people, they've literally got caught outside. Now, but some people are saying for Americans, it doesn't matter quite as much from the point of view, from the American authorities' point of view. You're taxed on overseas income if it's above a certain amount, and it applies anyway. Do you think this whole thing with the virus, lockdown, whatever, do you think that could affect some of the things we're talking about, or do you think for Americans the same fundamentals exist? It's not like a British person living in Dubai paying 0% tax and they get stuck in, I don't know, Sweden, high percent tax, and their tax residency accidentally changes?
Of course. Well, there's no such real thing as a US expat in terms of tax jurisdiction. And you are always reporting globally where you are. I mean, famously one of 3 tax jurisdictions with North Korea and Eritrea that tax on global systems. But to the point of on the virus and things, and Adam, you and I have spoken about this in the past. I mean, this is my personal viewpoint, I should state, not a professional one. But I think more governments and tax regimes will go to a position of taxing global income, because it's a very popular vote winner in politics to tax deemed overseas individuals earning outside of their territory, perhaps, but still taking advantage of it without taxing Joe Public with it, which is never a bad thing. I mean, dual tax agreements are in place, so it just means that those are paying their fair share. It just does create onerous elements on the tax regime, and the importance, therefore, of good advice and good structuring.
Absolutely. And we are seeing China and South Africa kind of de facto going that way, and some politicians in Canada have also been talking about it. So yeah, I think this US model, a few more countries could go down that route in the next 10 years. So that's very interesting. And also then, I mean, you've talked about a lot of the changes that have happened, like FBAR, FATCA, all these kind of things. Of course, no one can see the future, right? And you know, we've got an election coming in the US, which we might talk about a bit later. But I mean, are there any changes on the horizon, do you think, for Americans? Things that are going to be brought in the next 3 to 6 months for American expats that will actually maybe enhance these rules, for example?
European courts has lost a few cases regarding FATCA filing and that sort of thing. So normally I would perhaps be talking about what tax code changes we believe are going to be happening around the corner. Previously, as we would also of limits of what's available, of new aspects with it. The only thing I would say is that opportunity zone investing will be out globally, where you get dollar for dollar tax write-downs. That is the only thing that we know of is coming, perhaps in the good news column. In the slightly more negative news column with it, it's more around immigration. Obviously, we know that Trump has pretty much banned all forms of economic migrants other than repatriation back to the US, which obviously will stifle and does affect the globally mobile community, as we are all in, as what is affecting with it. But other than that, globally, we're going to go into a position of probably higher tax returns, of higher tax onerous with it, which I don't believe, again, my own personal viewpoint of this, I don't necessarily believe that tax levels will, so tax bans will increase at all, that I think that they will stay the same. I mean, Trump has reduced tax from 39.6 to 37 for expats, so that's a step in the right direction. What I do believe is that stronger enforcement of collection of tax, because systems are in place, common reporting standard is affecting globally, technology is making it easier. So I believe that the receipts of tax will increase by higher enforcement and sort of less sweeping under the carpet of where it be. So that's what I perceive to be happening in the future.
Well, it's interesting you say that, because obviously data is a big issue at the moment, but I imagine actually, I mean, don't get me wrong, I'm never encouraging somebody to just rely on lack of enforcement. That's not a good strategy, right? You should never rely on that, because you never know what could happen. But in reality, it's a bit like even counterterrorism, right? They have all this data, but they don't always know what to do with it. I mean, just the latest terrorist attack in the UK, I mean, they had data on him, but they didn't do anything. Now, the same I imagine with tax, they have all this new data, but until they actually get the technology, I mean, I'm not an expert because I don't work in the tax office, but I imagine that they actually don't know what to do with half of this data. But as you say, I guess when technology is getting better, they are going to be able to know what they're doing a bit more. Because when CRS was first brought out, and these kind of rules to kind of mean that everything was a bit more transparent globally, even though things are much more open, I'm not sure how much was actually enforced in reality, right? Because you actually have to do something then. And if you see somebody doing something wrong, you actually have to take action against it, right? So, yeah, for sure. And also, I mean, we talked about it before, but I often get, it's funny, when you do this job for a while, you get the same questions over and over again, right? So in 2016, people were saying to me, well, you know, I'm worried about Trump getting elected because I think markets might have a Lehman Brothers moment if he gets elected. And obviously everyone can look back at that now and say that was an over-exaggeration because markets actually went up. And now you've got a lot of people asking questions about, it could be the virus, it could be, oh, will markets go down if Joe Biden gets elected or Trump gets elected, or there's always going to be events in the news that worry people, right? I mean, what's your thoughts on that? I know you can't give investment advice in your in your position, but I guess from your point of view, it's always sensible to kind of, people just to stay invested, not try to time markets, and actually just focus on things they can control, like how they file taxes, and where it's fees, just anything they can control. What's your thoughts about the whole kind of news cycle as well? I mean, I think that kind of harms investors, I think, more often than not, that if they spend too much time watching the news, unless they take it with a pinch of salt, I actually think it can harm people quite a lot, because it starts to affect their decisions long term.
Indeed. Well, I would, the one part of investment advice that I can give is that obviously making sure the tax side of it is done is the most advantageous way. That expose yourself to PFIC taxation, 37% drag on a rising basis every year. So making sure structures are into deferred taxation, that's the easiest way of making sure that your returns are as high as possible. I am a classical economist by training. I am a macroeconomist, so I'm very happy to talk about that as well. So always interesting. What we need to do in terms of sort of the US political space, and therefore say global macroeconomics, is to remove the personality from the policies. That Trump was, before he had got into office, sort of unfairly villainized because of his personality before taking seat. So markets perhaps irrationally reacted to it. Republicans are always good for the economy. If you go back, if you want to go back until the inception of the Republican Party in 1860, cycles have always shown that. Democrats have always come in at the back of Republican rallies in the markets and implemented social change in that scenario. So a Democratic so in 2016, if Clinton had got in, then we would have perhaps not had the rally that we would have had. But again, I mean, in no way endorsing Trump as an individual. I really disagree. I mean, the man should just get off Twitter. It would make it do wonders for him. Actually, in terms of a politician, of America First, of what they've done in the economies, actually, he's been a very strong Republican economic president. Biden, on the other hand, is more of an unknown quantity. I mean, we probably would have preferred Bloomberg in essentially being a bit more of a Republican leaning with it. Biden, as vice president, was very keen on social change. He was actually quite keen on market regulation and interaction with it. So it's an unknown quantity, as every president is before they take office. But through extrapolating through economic history and theory with it, that you would expect a dampening of economic growth on a global spectrum under a Democratic Party.
Yeah, and interesting thing is also, and this is another unknown with what's happening now with the US and China and trade issues around the world, and of course what's happened with the virus. I know right now there's a lot of government spending, and you would think once people get out there, there's more liquidity. Who knows, that could actually be good for growth. But then also you have a lot of government debt, as you said, maybe more taxes. But I guess, as we were saying there before, you always have these things coming down the road, right? And people can never know for sure, the way markets are going to react to this. So, anyone who's been reading my blog, I'd just say keep investing, and also be well diversified as well, because if something happens again like March and bonds go, government bonds, or these short-term bonds go up a lot, markets are down, you can just rebalance and whatever. So, you should always have your eggs in more than one basket. But it's interesting what you said about that 37.5%. So basically, one of the key things you said so far is that for American expats who are living overseas, if they don't have the right kind of assets, it's 37.5%. Is that on the gain, right?
It used to be 39.6. It's now 37%. Yes,
still
exactly.
High.
So FBAR filing, so under a common misconception is that people say that they don't have to file, that they don't have to pay tax because they're under the income threshold. Investment's completely separate. So as we sort of establish under FBAR, it's accounts of over 10 grand that you're filing on, then you're filing on the growth of them. So as a US connected person, so a US filing individual investing overseas, if one was to invest in a PFIC, a passive foreign investment company, i.e. a non-US qualified investment, so anything other than a direct equity, so a European mutual fund, a European ETF, an Asian stock, even a company that you've invested in that you have no direct employment with will be classed as a PFIC. Every dollar that you earn from that company, you pay 37 points. You pay 37% tax on that on a rising basis. So it's accrued throughout the year. If it's calculated in so you've invested in euro, for example, you have to use the average exchange rate that year. So it's even possible to make a material loss but an FX gain on it that you're paying tax on. So it's very important for US connected persons. And this also affects, so say you are European and you've moved to the US and you are now a US taxpayer. The assets that you left in Europe or around the world, these are now PFICs as well. So these will all also be subject to this. The US takes into consideration everything that you have globally as soon as you become a US taxpayer. So average 7 years to do that, everything you've left. So cash is obviously not affected, but you're getting no growth on it. So it's making sure that you have those in structures and advice that you're getting in the correct way, that you're not having that drag on your investments on a rising basis. Because Adam, as you who would be trying to structure a portfolio, something that started 37% down, and you want to make a growth on them, you're going to struggle there, aren't you?
Absolutely. And you're saying then the 37%, how should people calculate this? Is it just on the gain? So let's say someone has 100,000 portfolio, it's now 200,000, or they have a bad year, it's down to 80,000. Is it just when they sell or just when it rises every year?
So it's declared on it. So there is something known as base, and then there's something as growth with it. So you can mark to market. It's actually subject to how the individual wants to do it, but you will be paying tax on the growth on it on a calculated time. It should be mark to market. So you pay every year on it. It's that calculation on your FBAR filing. So if 100 goes to 110, you'd be paying 3,700 of tax on that gain each year. If you can't get a pricing on it, you pay it next year. You would pay that 37% for 2 years over that period on the average FX rate with it. So that's how it works. We would always suggest going into structures which incur deferred taxation, which still have FBAR filing, so that for every year that 100 would grow to 110. You file it as 110, but you don't pay any tax on it. You only pay tax when you come to withdraw it. And what is key there is that 100 that you put in is never taxed. That's base. And then you can start using foreign tax credits to negate that base to increase it. So actually, say you are living in the UK with a higher tax regime than you are in the US, and you're overpaying on your UK tax bill, you would then incur some foreign tax credits that you could use against this to change some of that growth from growth tax to base tax and not pay any tax on it. So that's how we would suggest structuring. That's how we do things. And make sure
that's very interesting. Yeah. Oh, that's interesting because it's not just when they sell, right? It's when it's going up.
No, not at all.
Often.
Well, then you're getting the effect of compounding. That's the benefit of deferred taxation. I mean, this is not a US expat theory with it. This is globally. Paying tax at the latest stage to make sure you get all of the growth on it just means that you get an increased effect of compounding. Obviously, the tax bill is also compounded as well, but you're getting the greater amount, which is the most important element with that. But what's important with this is as I sort of said, this affects people that have moved to the US as well, or perhaps who have married an American and commingled their assets and now living in America, those Society Generale accounts that they've left in France will be subject to FATCA and PFIC and FBAR to make sure that it's important to consider everything there.
Yeah, that's right. So even people going to America just for 1 or 2 years for work is something worth considering, right?
Indeed.
Because it could affect people. Now,
And
which assets are not affected by this? So obviously cash, well, it's not really an asset, but cash is not affected by any of these rules. Now, there are a few other not many, but there are a few assets which aren't included, aren't they, in this? Most are, but there's one or two, some kinds of direct investments, right, are not taxed in
direct single
quite the same
holding,
way.
investments are not included in it. So portfolio is created around that. But as soon as you securitize or unitize that into, say, 5 stocks as an ETF, then it's included.
Mm-hmm.
So
yeah, if someone buys Apple, it's not the same thing as buying a technology stock.
Absolutely. So
Okay.
there is. So you can create portfolios that way, but very hard to create. The problem is that in order to achieve a diversified portfolio, as you mentioned earlier, of getting exposure to bonds, getting exposure to passive strategies, getting exposure, so you would need a family office approach, and to achieve diversification, you would need a very large sum to start with, which is fine if you are able to expose 5 million, 6 million to the market with it. But for us mere mortals, it's sort of creating diversified strategies at 100 grand. You have to be able to use collectors where you're a unit in a diversified element to it. And that's where you run into PFIC issues with it. So that's why fulfilling, and there is nothing wrong with PFICs. It's making sure that you use them in conjunction with the correct taxation on them to do it. So PFIC reporting and filing is on the ownership of the actual provider and the investor. So it's a double whammy that institutions cannot take you as well unless they are providing it the correct way as well. So it's the double effect of making sure an institution will take a US connected person, create the right reports, and then using those reports in a efficient manner to go to the right accountant to pay an efficient level of tax.
Yeah, absolutely. And it's interesting what you just said, and it's absolutely right as well, that if someone's got 100,000 or even 200,000 or 300,000, unless they want to take a big risk and like be, I don't know, 80% in Apple or something like that and 20% in something else, which is of course a big risk, then realistically, it's not easy to create a portfolio of individual positions and have some kind of decent risk-adjusted returns. Although what you're saying is anyone who's got any individual positions, it's not as onerous in some ways as something like an ETF, a fund, and so on. Okay, everyone. So I think we're going to have a few questions in a few minutes, but just another question. I think there's another. I could hear myself again in the background a little bit, but anyway, is the sound okay?
Yes.
Okay, no worries. Another question I was going to ask is, you mentioned about the different kind of structures that Americans can have. Realistically, though, obviously there's always going to be people in different positions. There's going to be some people who are very rich who are going to think, well, I'm going to spend a decent amount of money on accountants, lawyers, whatever, because it's a small percent of my income. But let's say an American has, I don't know, 100 grand. This came in from an inheritance. They don't particularly have a lot of income, but they've got this sum of money. A lot of these strategies you talk about, can they be done in a relatively cost-efficient way, or do you think there's a certain kind of threshold, maybe around 200,000, 250, or do you think like around 50, 100,000, 150? Do you think that's sufficient to put in place some of these strategies you're talking about?
So on this call, we've perhaps focused on the effect of someone who is a US expat of their assets which are overseas. One of the greatest things about being a US connected person is that you have access to the most mature, most diverse, most cost-effective market in the world, and that is onshore US investing. So be that in 401ks, in IRAs, in broker-dealer accounts, in just exposure to the US. As a US connected person, the easiest way of accessing that is actually by repatriating assets through a broker-dealer. Make sure you're not subject to US withholding tax on it. So that's something that we can make sure that doesn't happen, going through a registered broker-dealer there and investing that way. So the actual entry to a US connected person to repatriate is much lower. So 40, 50 grand. You're right. Sweet spots are still for US domestic investing, still around the 100 mark. And for US connected person for the overseas assets, you're looking at around perhaps the 200 grand mark, to make sure it's most efficient. With all these things, there are fixed and variable costs. So to make sure those fixed costs are paring into insignificance, that's the sort of levels that you're looking at sensibly there. We pride ourselves on being what is known as a mass affluent play. We're not a private banking play. We cover the sort of 50 to 5 million portfolio size. Not to say we do portfolios to 25 million on a regular basis as well, but of our bell curve distribution of where our clients are based at, it's around the 250 to 500,000 mark.
And I presume then when it comes to people who, for example, let's say Americans who are just starting out, young people who maybe have a decent income, but they don't particularly have wealth, would you say like monthly investing, it isn't really easy to do it for Americans, or you can do it through the onshore US brokers and you just pay like similar to like a Hargreaves Lansdowne in the UK, where you do like 500 a month quite cost efficiently? Is that easy in America for an expat, or a bit more difficult than in the UK market?
It's very easy for a European expat in America. They're able to set that up through broker dealers, through Vanguard, through usual partners, interactive brokers that we would use. For a US connected person to be able to do it, it's that you have to, we've got T. Rowe Price, or it goes back to one of our first points about connectivity of using information, that people need to have a residency or be going through a international registered broker, which we are one of the very few that are able to do that. So being able to you have to either give a real US address, not your parents' address. They'll be able to see you using Instagram and Facebook where you truly are. Or you have to use a broker in order to open these accounts. So that's the way. And obviously that's going through, as soon as you're using a broker to go through this, the entry requirements are slightly higher, around the 40 grand, but then monthly is really not a problem at all.
Yeah, from the initial investment, if you've got 40 grand in these kind of accounts, you can keep putting more in. That makes sense. We're going to open up the floor to questions. So if you've got any questions, I think you can type them down in Zoom, and I'll be able to see them. I did get one question beforehand, though, for somebody who actually couldn't attend the webinar, and that was about property. Now, what's interesting is obviously property is a completely different asset class to most of the ones we're talking about. And I guess it could be confusing because there's different ways of buying property as well. Some people even go for land in Southeast Asia and whatever. Is property treated in the same way? Let's say an American watching this has an apartment or a house or a piece of land even. Would that be treated in the same way as indirect property, like a REITs or loan notes?
So making a gain on a property as a US connected person outside of the US would be counted as a PFIC. So you do have to be careful about that. Also, closing off debt facilities such as mortgages can be counted as well. The good thing is, as a US connected person, you are able to value and write into contract. Trusts now have full look through to the underlying, so you have to use a contract agreement with it. You are able to use investment property and write it under contract, so that you can both protect it on a rising basis and a multi-generational purpose with it. US property can be written into trust very easily. I mean, as we have sort of seen this under benefactor foundations and endowments, this has been a legacy plan for a very long time, so that can be used that way. But primary property, fine. Investment property can be more complex. The good thing is, though, that there is actually US property investment opportunities which go out, which are also opportunity zone investing, which you get dollar for dollar tax write-downs for going into as well. So depending on the individual attitude to risk and appetite for risk and investment exposure, that you can get both the advantage of exposure to property under an investment aspect and tax relief from it. So Adam, and to put this in terms that perhaps others would understand, it's very similar to sort of EIS and VCT investing. And for those watching the current series of Billions, that you'll know that there's sort of arguments around opportunity zones working into. So very in vogue at the moment.
Yeah, I was just watching that actually yesterday. But the lead characters from another, the lead characters from another series, so I can't really put him in that season for some reason. I kind of typecasted him from the other one. I think it's Homeland or something like that he was in. So yeah, but yeah, it's all good. That makes sense. But I guess here's the interesting thing. A lot of Americans say invested into property or another asset maybe 20 years ago or even 10 years ago, before a lot of these tax laws came into being, right? In that case, do you think it's always better just to sell if they can and let's say just deal with it? Or do you think in that case, I mean, because property is an asset, you can't just sell it. Often it takes months. Do you think it's better to say sell it, take the tax hit, invest back in America more tax efficiently? Or do you think it's just a case of, well, it's tough luck, you know, things have changed, tax have changed, and just try to get more capital gains from it and see what happens in the future?
Well, Adam, I wish our job was as easy as that. I could give overarching opinions to all property holdings with that. No, I'm going to give the awful answer that no one ever likes hearing. Is it's case by case scenarios. It's what growth is still there. Just on your point about tax law changing and affecting people, yes, it does. But remember, it does affect those most informed as well. There is one very famous, very high profile case of Boris Johnson got done by this because he was born in America. So he is a US connected person, despite never living there, entitled to run for presidency of the US as well, because he was born on US shores, but lived there for 6 months. And his parents are obviously of German and Ukrainian descent as well. So sort of true global national with that. But his property that he made a gain of 4.4 million in London, the IRS came after it as well, and he was not aware that he had to pay tax on it. So even those most informed get this wrong. So that's the importance of making sure advice and that you're using everything that you can to mitigate against that. But we will get it wrong. That's a good example of the confusion surrounding it.
Absolutely, and that's a good point, right? So US connected persons, it doesn't necessarily have to be someone who's, of course, American or an expat living in America. Someone who was born in America, who gave up their passport, you know, like Boris Johnson's an example of that. I think if you're married to an American as well, sometimes it can also be, you could be implicated in some way.
You have a joint bank account, for example.
Yeah, so if you're married to an American, even if you've never lived in America, never been in America, but you have joint bank accounts, joint brokerage accounts, or whatever, then you can also be affected. So it isn't just for Americans per se. Okay, Bjorn, well, we've had quite a good session, and it seems like we don't have any questions from the floor. I think some of you are a bit shy maybe, and it's a bit late for some of you guys, but it's been a good session, and I'll also put this online, so I know some people will want to make their own comments as well. So thanks a lot, James. Any final questions? Anything you think people should be most aware of? I think the key point is, I guess, staying well informed, getting advice when you need to, because these things can always change, right?
And don't be fearful of putting your capital to work.
Absolutely. Cash is paying nothing now, right? So don't be fearful of that. Okay, well, thank you very much, James, and thanks everyone for attending. Have a great day, and we'll see you next time then.
Absolute pleasure. Thank you all.
Thank you.